Today's episode is from a live BMO event that was recorded on March 5th. The topic was Navigating Tariffs, Economic and Market Impacts for Canada and the U.S.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Welcome, everyone. Welcome to BMO's discussion, U.S. Canadian tariffs, economic and market impacts. I'm really thrilled that everyone could join us today. As we open up the discussion, the headlines keep rolling. There's uncertainty that continues to flow. The core themes really around tariffs and the U.S. Canadian relationship. Accordingly, we really wanted to bring some of our experts for a really quick 30-minute update in terms of how BMO's seen the impact on economics as well as markets. I'm Camilla Sutton, MD and Head of Equity Research for BMO for the UK and Canada, and I am really happy to be moderating today's discussion. I'll get started right away by introducing our panelists. So we have Doug Porter, Chief Economist at BMO, as well as Young-Yu Ma, Chief Investment Officer at BMO Wealth Management, U.S. We've got about half an hour dedicated to today's discussion, and about half of that's going to be dedicated to audience Q&A. And to start, I thought it would be most useful if we had both Doug and Young-Yu provide 2 or 3 minutes, high level, how they're seeing the impact of tariffs on economics as well as on markets. And with Doug, why don't we turn it to you so you can kick us off?
Sure thing, Camilla. Thank you very much, and good afternoon, everyone. Well, from an economic lens, I'll say that there is some debate on just how big the impact is from a trade war on both growth and inflation, and on which of the two is the dominant effect, but there is no debate on the direction. Tariffs and trade wars weaken growth and they lift inflation, which is not a good combination for the economy or for financial markets. In terms of which is dominant, my view is that weak growth will be the more important or the bigger force of the two. And the market now seems to be saying that as well. And ultimately, I believe that is what central banks will react to. I think it's very telling that the bond market has been reacting that way as well in recent weeks. For instance, U.S. Treasury yields are now down from pre-election levels and 50 basis points from the high that was hit less than 2 months ago. If anything, we've seen an even bigger impact in Canadian yields where the growth hit will be even heavier. Their 10s are now well below 3% and off 40 basis points since the very first warning shot on potential 25% tariffs were fired way back in late November. We're now awaiting any news this afternoon if Canada and Mexico are going to be exempted in certain industries from the full tariff hit. But I'll say that any remaining tariff will still weigh on growth and leave us with lingering uncertainty. Plus, there's the potential for renewed action that's hardly going to go away, which will cloud the outlook and keep a dampener on business investment, whatever news we hear later today. So the bottom line in terms of what it means for the economy, and there's still many moving parts and unknowns, is that the net impact is that growth will be lower, especially in Canada, and inflation will be somewhat higher, probably a bit more in the U.S., with the precise impact dependent on where we land on tariffs and how long they last. But just to put some numbers around it, very roughly speaking, and assuming that tariffs last for a year, we're looking at a cut in U.S. GDP growth of between 1/4 to 0.5% this year and next, and a bump in U.S. inflation also of about 1/4 to 0.5 point in both years. In Canada, as I said, the growth impact of these tariffs would be much heavier. We've cut our growth outlook for Canada both this year and next by roughly 1.5 points. We were looking at something close to 2% growth in Canada before this, and so now we're looking at something between 0 to 0.5% growth for both this year and Canada. We're also looking for roughly 0.5 point lift to inflation this year, which we think in the case of Canada will wear off by next year because of that much weaker growth outlook. And the net result of this economic outlook is that we think central bank rates will on net be lower, especially in Canada, And there is also still some further downside to the Canadian dollar as long as the trade war persists. I'll just end by saying it's very interesting how relaxed the Canadian dollar has been in the past few days, and I think some of that is because we had the clear risk of a full-on trade war already built into the currency, and I think there's also this view in the markets that it may well not last long, and it won't last a year. If it does indeed persist, we think the Canadian dollar is ultimately going lower. We think it's likely to push up towards about 150 per U.S. dollar if this trade war does persist. And that's it for my big overview. Oh, thank you.
That was a great way to start, Doug. Thank you for that. And you, what about you? Do you want to give us 2-3 minutes in terms of how you're thinking about the impact on markets?
Yeah, absolutely. Thanks, Camilla. I think the markets are in for a continued rough patch here, and it's important to put this in context. It's not only the trade war that's going on now, it's where we are in the trade war. It's still relatively early stages. Doug alluded to that, but also President Trump is talking about tariffs coming April 2nd as well on various industries, probably the EU as well. So we're not even halfway through this. I think that's the important thing to keep in context for where the markets are. That's one part of the context. The other part of the context is there's also other disruptions going on at the same time. In the U.S., the DOGE disruptions are very real and very acute. There are going to be spending pullbacks. There's going to be fiscal restraint going on, as well as layoffs happening. So you see these disruptions, both tariffs and DOGE, happening at the same time. You're already getting weak data coming out of survey measures, coming out of the labor market. We had another weak data point this morning in the U.S. as well. So in that context, there's certainly the prospect that you can build some degree of downward momentum, both in the economy and in the financial markets. I think there are two good things when we look further out that we can talk about. One is that the Fed probably will look through some of the inflationary effects as relatively short-lived, and at some point later in the year, be willing to resume that rate-cutting campaign. But another thing is later on in the year, we also have the prospect of tax cuts. But in the meantime, we have this timing mismatch. The disruptions and the difficulties are coming here and now. And I don't think that the president and the administration can keep this trade war going strongly for a long period of time. I think actually the currency market is telling us that. For a while, it was believed that if the U.S. accelerated this trade war, that the U.S. dollar would strengthen, other currencies would weaken. What you're actually seeing, at least in some currencies, is the opposite. You're seeing the yen strengthen, you're seeing the euro strengthen, and even the Canadian dollar, it's holding its own, as Doug mentioned. I think what the market is telling us is the U.S. isn't not in that robust of a position, and we're going to start to see pushback very soon from other Republican lawmakers who are more free trade oriented. We're going to start seeing layoffs in the not too distant future if these 25% tariffs stay on. Even if they're rolled back to a degree, we're still going to see very meaningful disruption. So we don't think this can last for long, but even so, put in the context of larger disruptions and softer data coming out of the economy in the U.S., we do think that means markets are in for a bumpy ride because we have this timing mismatch. The good things potentially that are happening or that should happen to the economy and markets aren't going to be for a few months still. So it's more of a time for patience and time to look for longer term opportunities and understand that this could be a very volatile period here.
Doug, let's go back to you here. You know, when you think about the consumer and you think about businesses and you think about the level of uncertainty that we've seen in just the last month and a half, how do they manage through that? And what are the economic impacts of living in a time in elevated uncertainty like this?
Yeah, and it's first of all, it's hard to understate just the degree of uncertainty that consumers and businesses are dealing with, and we have seen a pretty notable pullback in consumer confidence on both sides of the border. I would point out in February, even before the trade war began, we had seen a pretty big decline in both Canadian and U.S. consumer confidence. I don't doubt for a moment that it's probably grown a little bit more intense as with the reality of the trade war now upon us in March. And I would expect that's going to be one of the first areas that you do see some real weakness in the economy showing up is in consumer spending. I mean, a lot of folks, of course, have been focused on what this means for exports, for business investment, but I also think the weight that we're likely to see on consumer confidence will be fairly immediate as well, especially when it comes to big ticket spending, such as things like autos and homes. We had a little bit of a taste of that in recent home sales data in Canada. We did see a bit of a stalling out or a freezing up of the market in the first couple of months of the year, and it's understandable when there's so much uncertainty. Do folks really want to go out and embark on one of the biggest purchases of their life? Probably not. So I think it will put the uncertainty alone, I think, will put a bit of a chill on the growth.
And in terms of from your side, typically, how do you see investor sentiment moving when we're living in these times of uncertainty? When you think about investors, what is their sentiment right now? And what are you thinking in terms of how they should be thinking about different asset classes, both today, but also for the longer term?
Yeah, that's a great question. Investor sentiment had been falling for a few weeks in a row. There are different survey measures of investor sentiment. There's even some talk about how sentiment perhaps is so far washed out that it might be time for a bounce. We don't actually think that. In the short term, we do see some of those sentiment surveys becoming quite negative. But in terms of actually creating a durable bottom in markets, you tend to have repeat bottoms and multiple sort of grinding lower before you can actually get a durable sentiment bottom. So we don't think that that's worth trying to trade around, but we do see the challenges with investor sentiment. Certainly consumer sentiment in terms of pulling back on purchases is likely to take place here. And the trade war, when you see rising prices, when you see concerns about the labor market, potential for layoffs, that's all going to start to reverberate through the economy. And the question, I think, is how sensitive is President Trump going to be to these, both to the stock market, but also to the changes in the economy? It does seem like he is willing to take some degree of pain in the markets and the economy. The question is, at what point does he really try to accelerate some type of deal-making activity and come to agreements with the U.S., Canada, and other trading partners, rather than hold out for what he may really want to push and really want to achieve that might entail a much greater disruption and maybe not even be achievable. So I think that's an open question that the markets are trying to understand now, is what exactly is that sensitivity of the president? And so far, the indications, I would say, are not positive in terms of last night, the president's speech talking about bracing for a period of disruption or something that may cause some temporary challenges for the economy. So we just have to see how that plays out. But as these disruptions become more acute, certainly there's a greater prospect of the president starting to shift his positioning.
Doug, dollar Canada or the Canadian dollar, I know you said that it's held in fairly well given the circumstances around it. But when you think about the Canadian dollar and the weakness, how much is a weaker Canadian dollar an offset for the economic impact, and vice versa for the U.S.? If we have a stronger U.S. dollar, how does that really impact the U.S. in these times?
Yeah, and to some extent, the currency market is actually acting as a buffer or an offset to the threat and the actuality of tariffs. I would say that if we were talking about a 10% tariff, and that early on, that was one of the rumors that the administration was planning a 10% universal tariff, I would say the currency market probably could have done a lot of work in offsetting that. We'd actually seen the trade-weighted U.S. dollar rise by about 8% over the past year. We've seen the Canadian dollar come down, depending on which time frame you pick, by about 5 to 7%. That would have gone a long way to, frankly, mitigating or washing the hands of a 10% tariff. A 25% tariff is a very different world, though. The currency can only slightly offset that. I don't believe that the Canadian dollar could nearly make a big enough move, or would nearly make a big enough move to offset the growth dampening impact of a 25% tariff. But if ultimately we do land on broad-based tariff, and that could be where we do go, I actually personally think the currency market could do a lot of do a lot of the work offsetting that. But as Young Yu has pointed out, the currency market's got its own ideas now. We're actually starting to see it move in the opposite direction, and in the last couple of days, as there have been some renewed concerns over the U.S. Growth environment. That too is being, of course, reflected in the Treasury market. So I just wonder whether how sustainable this move that we've seen in the U.S. dollar over the past year actually will be.
And so back to markets for a second. If you're looking out kind of a year and a half, how are you advising clients to position given the tariffs and the uncertainty right now?
Yeah, I think that's a relevant time frame to consider, or at least consider what does the year-end picture look like. And we do see that elements can come together for stability, for this disruption to pass, or at least be substantially mitigated, and businesses to be able to adjust to these difficulties that are upon us now. So we do think some of the fundamentals that underpin the economy, including productivity, including the proliferation of AI and sustained profitability by companies, continue to look favorable. The problem is these near-term disruptions are very acute and will dominate the headlines and dominate investors' psyche for quite some time still before some of those favorable factors, potentially including or likely including Fed rate cuts later in the year, start to come into play. We do think that that's probably the point at which sentiment turns, is when the Fed is likely to start cutting rates again, or at least when that's back on the horizon, when those disruptions settle and when the Fed starts looking past near-term inflation and looking to cut rates to offset some of the weakness in the labor market. But that's not going to be for at least a few months still. So in the near term, you really have to be patient. I mean, that's part of what's happening and what's playing out. Panic selling is almost never the way to go. And so we don't advise selling into a downturn. The only time that's even a potentially sensible move is if there's a systemic problem in the economy. We don't believe there's a systemic problem. These issues that we face now are very acute in the moment, but they will pass. And some of the underlying fundamentals still look good. So looking for opportunities, but being patient, being very patient with those opportunities, not looking to jump at what you might believe is the first opportunity that arises, not just looking for good opportunities, but perhaps holding out for very good or even great opportunities before deploying new capital, because those may come along in the coming months.
Terrific. Well, we're turning now to audience Q&A. We have quite a lot of questions that have already come in. Doug, we've got a few for you. One is there a potential economic bull case or positive case for the U.S. economy with tariffs being added?
I tend to think not, to be honest. I will freely admit that this is an asymmetric trade war. Definitely the largest trading partners of the U.S. are much more vulnerable here to a growth downturn. For instance, Canada and Mexico in particular. China, it's a little less clear cut. The U.S. will definitely not be hurt as nearly as much. Just to put some quick numbers around it, Canadian exports to the U.S. Make up a little bit less than 20% of Canadian GDP. U.S. exports to Canada make up only a little bit more than 1% of U.S. GDP, and it's roughly similar calculations between Mexico and the U.S. as well. So it's very much one-sided. It's clear who's got the leverage here. But having said that, there's really not much of an upside for the U.S. from a trade war in terms of the growth impact. We have seen some announcements of planned investments. A Honda plant, some of the chip investments. I don't think that offsets or comes close to offsetting some of the dampening impact that we're going to see from a trade war. Whether that's the increased cost of intermediate goods to U.S. producers, or even the kind of retaliatory measures that we're looking at from each of Canada, Mexico, and China. All of those things, along with the rise in the U.S. dollar, by the way, over the past year, all those things will tend to dampen U.S. growth.
There's quite a few questions, too, in terms of the retaliatory tariffs. Can you speak a little bit to that, Doug? And then, Young Yu, will move to you with some more markets questions.
Yeah, and I think this is actually one area that's been a little bit understated, just how important the kind of retaliation that, for instance, Canada has spoken about. We haven't heard the details of what exactly Mexico is going to do, but I suspect it'll be of a roughly similar ilk. And just as a quick reminder, what Canada's talked about doing is eventually putting a 25% tariff on roughly a third of what Canada imports from the U.S., which is about $155 billion worth in Canadian dollar terms. It's interesting, in a static analysis, that would raise almost $40 billion of revenues, which I would assume the government is planning to reimburse across industries and workers. But that's more than 1% of GDP in terms of tariff revenue. So this is a very important, large step that the government is potentially taking. It wouldn't have an outsized impact on the U.S. economy, but it's not nothing. And there are certain sectors that it would create pain. I believe in certain regions, certain industries in the U.S. That's probably the biggest retaliation that I am aware of, or the biggest trade move that the Canadian government has ever made. And that's only a third of what Canada imports from the U.S.
There's quite a few questions here around how the market is interpreting this and whether or not they fully priced the risk of tariffs into markets. So maybe a few thoughts from you in terms of how much do you think the markets are reflecting the full tariffs, partial tariffs, just ongoing uncertainty?
Yeah, that is a difficult question to assess, because how long this stays in effect, what levels of tariffs are at, is very uncertain at this point. I think that's what the market's grasping to try to figure out. And even when we get announcements which play into what President Trump is looking for, at least one thing he's looking for, which is announced factories being built in the U.S., whether it's by Honda, Taiwan Semiconductor, or Apple, announcing building manufacturing in the U.S. The challenge with that is the president really wants to tout that, wants to push that. But I think the reality of the U.S. economy is that can only go so far. You just can't get labor to fill the type of demand that the president would hope to even get from enacting a trade war like this. So it's difficult to know at what point there's a level of satisfaction among the administration that enough of the goals have been achieved through tariffs, and that there's some tariff level which is stable and sustainable that the administration is willing to settle on and let businesses adjust to, whether that's 10% or whether that's some form of reciprocal tariffs, how that works. I think that's what the market's grasping at. Right now, if you take the trade war and assume more negative outcomes, I don't think the market is pricing that in right now. I think the market is pricing in a relatively quick deal with Canada and Mexico, meaning within the next few weeks, that if tariffs don't come all the way off, they at least come down to, say, 10%. I would say that's about what the market's pricing in now, 10% tariffs a few weeks from now. If it's worse than that, if the situation stays at higher tariffs for longer, then I think that's a much more difficult path that the markets could be faced with. But conversely, if there's good news which could come out in the next few days, it's very difficult to know, then perhaps we could get a bounce off of that. But I wouldn't look to that bounce as time to jump into the markets, because at least in the U.S., we still have the prospect of tariffs being put on other countries and other industries in April. So this isn't nearly finished, even if we get short-term reprieve.
There's lots of questions in here about USMCA. What negotiations look like going forward? Does it even matter going forward? Any thoughts in terms of how we see USMCA, or also known as NAFTA, unfolding from here?
Well, of course, one of the favorite theories out there, not necessarily shared by me, but one of the favorite theories is that this is all just an opening shot or an opening gambit ahead of the mandated review of the USMCA as of basically the middle of next year. Frankly, given what we've seen in the last month or so, I think it would be very difficult for Canada and Mexico to sign on to anything. I know there's a bit of a split opinion on that front. Some have argued, this shows, this is exactly why we need to immediately, engage in negotiations and sign a new deal. Whereas others have said, why even, go there if this administration can so readily walk away from a deal that itself signed, in 2020. I personally tend to come down on that side of the ledger. I'm really not sure why Canada and Mexico would be making concessions and, trying to reach a deal that then could be ignored or, ripped up a year from now. So I think this is a very unfortunate development. That's not to say we should completely shut off channels on that front, and completely, say no to further negotiations. But I would just go into it with both eyes wide open, under the full realization that the negotiate or whatever the result is might not last.
Several questions about a recession, even frankly one about a depression. Thoughts first, Doug, and then Young Yu, in terms of, is there risk that we fall into a deep recession either in Canada or the U.S.?
So I really am reluctant to throw around the R word ever, unless it's very clear that that's what we're heading into. I do believe that if we were looking at the kind of tariffs that are in place as of now, if they were to persist for a year, that it would be very difficult for the Canadian economy to avoid at least a technical recession. That's essentially what we are assuming, that we would have at least two quarters of negative GDP. Again, as we've pointed out a few times, it's not at all clear that these tariffs are going to last a year. They might not last the day. We'll see. But for the U.S., I think you're hearing talk about stagflation and potential recession. I think it's really early to be talking about that. First of all, I do want to address the Atlanta Fed nowcast, where it's calling for a big decline in Q1 GDP. That is not a complete report. That's taken on board a surge in imports in the early part of the year without the offsetting impact of a big run-up in inventory. So I think that's a bit of a false signal. But there's no question that growth really did slow in the U.S. at the start of the year. I think it would be a stretch to say that we're headed for a recession in the U.S. just yet. Even if we are in a trade war, it would weaken U.S. growth. But I don't think we're in the league of a recession yet in the U.S.
I would agree with that, and that the degree of imbalances in the U.S. economy are not so pronounced that you would expect a recession to easily unfold. So you don't have high leverage in the consumer sector, you don't have high leverage in the corporate sector, and recessions, of course, can come from shocks, and that's what we have right now. The question is then the degree of shocks and the persistence and longevity of those shocks. And I do think that President Trump would, and the administration and other leaders would see that those shocks, when they become too acute, would start to walk back the tariffs and be much more inclined to make deals. So could it happen? Could we get a downturn? Yes, we could get some momentum building to the downside, but the fortunate the two fortunate aspects are, one, we don't have those imbalances, and the other side of it is the Fed at some point should be cutting rates again. So if there is something that looks like recession, it probably wouldn't last too long.
You're both very balanced in your comments, and so there's quite a few questions in here about safest investments and protecting your capital, other pieces like that. Young Yu, do you want to just give us a very high-level view in terms of asset allocation in times of uncertainty?
Yeah, I think staying relatively balanced here still makes sense. Of course, having some cash on the sidelines is always nice. Being at least neutral or somewhat long-ish duration for fixed income provides some safety in portfolios. We have seen those growth concerns lead to a decline in the 10-year Treasury yield, as Doug alluded to before. When you think about inflation and growth, the inflation is relatively temporary, or at least not long-lasting, but the growth concerns could be longer-lasting. And so to the extent that these tariffs are in effect for longer, you probably would get some buffer in the portfolio from having longer duration fixed income. That does provide an element of stability in portfolios. But again, looking for opportunities. I mean, we don't want to completely be closed off here to the idea that as this unfolds, there can be good opportunities that come along. But where to look for safety? Yeah, longer duration fixed income is probably the most relevant area right now, where you're going to get that safety in portfolios.
The overarching message seems it's no time for panic. There's a lot of pieces unfolding, and we still have to wait to see an awful lot of what will transpire for both the Canadian and U.S. economic and market landscapes from here. And with that, thank you, Doug. Thank you, Young Yu, and thank all of you for joining us today. We hope it was helpful.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.